Welcome back to the Pro Ticker Podcast. It's your Monday morning edition, covering major financial magazine headlines. Everyone get ready. We're diving into a whirlwind of global market trends this week, from a new investment strategy taking root in Asia, to some really intriguing economic signals coming out of China. Oh, and we've even got potential shakeups brewing in currency markets, as the Fed appears to be adjusting its interest rate plans. And just to add another layer of complexity, political turmoil in France, and Argentina's bold, but maybe risky, gamble to attract investment. So to help us connect the dots between these seemingly disparate headlines, we have our expert back with us.
It's a pleasure to be back. There's certainly a lot to unpack this week. It's shaping up to be an interesting time, maybe even a turbulent time in the global economy.
All right, well, let's just jump right in then. First up, this value-up strategy in Asia that Bloomberg is highlighting in their article. Markets rush to value up maybe Asian stocks' best defense from Trump. It almost sounds like a marketing campaign. But the article suggests it could be a pretty significant development. What exactly does value up even mean, and why are we seeing this trend emerge now?
Well, value up basically boils down to Asian governments becoming more and more proactive in their efforts to boost their stock markets and attract investment. Think of it as like a coordinated push to enhance shareholder returns, improve corporate governance, and ultimately drive higher market valuations. And it's no coincidence that this is happening now.
Right.
Given the potential trade headwinds stemming from some of Trump's policies, many see this as a way to make Asian markets more attractive to global investors, especially as concerns about a potential slowdown in other regions like the U.S. continue to linger.
So it's a way to kind of shore up their defenses and maybe even gain an edge in the global market. The article mentions that Japan's success with similar reforms over the past decade is a key inspiration here is their recent market performance. Truly tied to those reforms?
Yeah.
Or are there other factors at play?
Yeah, it's likely a combination of factors, but the reforms have undoubtedly played a role. Japan's corporate governance has improved significantly, and companies are now more focused on returning cash to shareholders and being more transparent. Look at the Nikkei 225, for example. It's soared to record highs this year. Now, is that solely due to reforms? Probably not, but it's certainly a contributing factor.
It does make you wonder if it's a model that can be replicated across Asia, or if Japan's unique circumstances make it an outlier. The Bloomberg article cites India as another potential bright spot, highlighting Prime Minister Modi's reforms for state-owned enterprises. But it also points out challenges in South Korea, where the Kospi index has actually dropped despite new measures. Is this trend really sustainable, or are we just seeing some short-term gains? That might fade over time.
That's the million-dollar question, isn't it? Sustainability is key here. Some investors are undoubtedly skeptical. Especially given the history of government intervention in some of these markets, there's always the risk of unintended consequences. But others, like the fund managers at Robeco and SGMC Capital quoted in the article, see this as a structural shift with the potential for long-term gains. Time will tell who's right.
All right, well, while we wait to see how this value-up strategy plays out, let's turn our attention to some actual economic data. Coming out of Asia, CNBC's Asia Markets Live blog has some interesting updates, particularly when it comes to China. They're reporting that China's manufacturing PMI reached its highest level since April, indicating expansion in the sector. That sounds promising.
It is encouraging, especially considering the concerns we've been hearing about a potential slowdown in China's economy. This latest data suggests that those fears may have been overblown, at least for now. A manufacturing PMI above 50 indicates expansion, and China hit 50.3. So things are definitely moving in the right direction. And this isn't just limited to China. CNBC is also reporting that Australia's retail sales are surging, up 3.4% in October, which is the fastest growth they've seen in over a year.
So does this mean we can breathe a sigh of relief? Are fears of a global economic slowdown unwarranted?
Not so fast. While these are positive signs, it's important to remember that the global economic picture is quite complex. There are still plenty of reasons to be cautious. Europe, for instance, isn't looking as rosy. And even with China, we need to consider long-term sustainability and potential headwinds.
That's a good point. Things can change quickly. Speaking of potential headwinds, CNBC is also reporting that global oil supply is projected to be in surplus in 2025, which could impact prices. What does this mean for energy markets, and how should investors be thinking about this potential surplus?
While a surplus typically puts downward pressure on prices, which could be good news for consumers, but challenging for energy producers, investors in energy stocks will need to pay close attention to how companies are managing their production levels and costs. In anticipation of this potential surplus, it's also important to note that geopolitical factors can play a significant role in oil prices. For example, despite the shaky ceasefire between Israel and Lebanon, Oil prices are actually edging up. According to CNBC's, oil inches up on upbeat China data, shaky Israel-Lebanon ceasefire that suggests that market sentiment is being driven more by the positive economic news from China than by the geopolitical risks in the Middle East, at least for now.
So we've got a mixed bag of economic signals, some positive, some concerning. It really highlights the importance of staying informed and nimble. Now, what about the U.S. and its impact on global currency markets? CNBC has a couple of articles. Dollar faces crunch week for U.S. rates, yen holds gains, and gold falls on firmer U.S. dollar, profit-taking, key U.S. data in focus that are shedding some light on interesting developments. It sounds like the Fed's actions are taking center stage.
They are indeed. The big news is that while the Fed is widely expected to cut interest rates this month, the market's expectations for further cuts in 2025 have actually diminished. This suggests a more cautious approach from the Fed, which could be influenced by a number of factors, including upcoming U.S. jobs data.
So it's not a done deal that we'll see multiple rate cuts next year. What would make the Fed decide to be more aggressive or more cautious in its approach?
Exactly. The Fed will be carefully watching key economic indicators, particularly inflation and employment data, to gauge the health of the U.S. economy. If inflation starts to pick up, they might be less inclined to cut rates aggressively. On the other hand, if we see signs of a significant slowdown, they might be more inclined to provide additional stimulus.
It sounds like a delicate balancing act. And speaking of balancing acts, what about the impact of the Fed's actions on other currencies, especially with the U.S. dollar strengthening? The CNBC articles mention that this is putting pressure on commodities like gold, and that the Japanese yen has rebounded after the Bank of Japan hinted at potential rate hikes in the near future.
It's all interconnected. The dollar strength makes U.S. exports more expensive and imports cheaper, which can impact trade balances around the world. It can also make it more attractive for investors to hold dollar-denominated assets, which can draw capital away from other markets and put downward pressure on their currencies. The yen's recent rebound is particularly interesting because it signals a potential shift in monetary policy from the Bank of Japan, which has kept interest rates near zero for years. If they start raising rates, while the Fed continues to cut, it could create a significant divergence in monetary policy between the two countries, which could further strengthen the dollar against the yen. This has significant implications for businesses and investors operating in both countries.
It sounds like we need to keep a close eye on both the Fed and the Bank of Japan in the coming months to see how this all plays out. Now, shifting gears to Europe, let's delve into the political drama. Unfolding in France, Bloomberg's article, "France won't be blackmailed over budget," finance minister says. Paints a rather tense picture, doesn't it? It seems like this budget standoff is really heating up.
It is. And it highlights how quickly political instability can rattle financial markets. France's far-right leader, Marine Le Pen, is essentially threatening to bring down the government over budget disagreements, which has spooked investors.
The article mentions that French bond yields have widened compared to Germany, which is usually seen as a safe haven in times of uncertainty. And to add fuel to the fire, the euro is weakening. Amidst all this uncertainty, what exactly does this widening of bond yield signal? And what could be the broader repercussions if this political crisis deepens?
A widening of bond yields essentially means that investors are demanding a higher return for lending money to France, as they perceive a greater risk of default. This is because political instability can undermine confidence in a country's economic prospects and its ability to manage its debt. If this political crisis in France escalates further, it could lead to a loss of confidence in the Eurozone as a whole, potentially triggering a broader sell-off in European assets. It could also have ripple effects on global financial markets, as investors seek safer havens.
It's a domino effect that we definitely want to avoid. And unfortunately, it's not just France adding to the unease in Europe. CNBC's European Markets Live Updates blog is highlighting labor unrest in Germany. Apparently, there are strikes underway at Volkswagen plants across the country as wage conflicts escalate. This seems like more than just a local issue. Could this be a sign of broader inflationary pressures building in Europe?
It very well could be. Wage disputes and strikes are often a leading indicator of rising inflation, as workers demand higher wages to keep up with the rising cost of living. This puts pressure on businesses to raise prices, which can further fuel inflation. The European Central Bank will be watching this situation closely, as it could influence their decisions on interest rates. If inflation starts to pick up significantly, they may need to reconsider their current plans for rate cuts, which could have implications for economic growth in the region.
This is where things get really tricky for policymakers, isn't it? They're trying to strike a delicate balance between stimulating growth and keeping inflation in check. And these political and economic headwinds are making their job even tougher.
Absolutely. It's a challenging environment to navigate, and the stakes are high.
Let's shift our focus now to South America, where Argentina is taking a rather bold, some might say risky approach to attract foreign capital. Bloomberg's article, Milei touts $50 billion from investors eyeing 30-year loopholes in Argentina, dives into this strategy. It seems like their new president, Javier Milei, is really shaking things up with his libertarian approach.
He certainly is. Milei is offering companies long-term tax breaks, currency benefits, and legal protections through a program called RDRI. His goal is to attract a whopping $50 billion in foreign investment and jumpstart Argentina's struggling economy. It's a bold move, but it remains to be seen whether it will be enough to overcome the deep-seated skepticism that many investors have towards Argentina.
That skepticism is understandable, given Argentina's long history of economic volatility and its current currency controls. As highlighted in the Bloomberg article, they've had their fair share of challenges over the years. Are investors buying into Milei's vision, or are they hesitant to jump back into a market that has burned them before? While early pledges have fallen short of Milei's ambitious target, which suggests that many investors are taking a wait-and-see approach, they're likely looking for concrete signs that Milei's reforms are taking hold, and that Argentina is truly committed to creating a stable and predictable economic environment. The currency controls are a particular sticking point. For foreign investors, they want to be sure that they can easily convert their earnings back into dollars and repatriate their profits without facing bureaucratic hurdles. So it's a gamble for both sides. Milei is gambling that his reforms will be enough to entice investors, and investors are gambling that Argentina will finally turn the corner and deliver on its economic potential. It'll be interesting to see who comes out ahead. Now let's head back to the U.S. and check in on the retail sector, where we've seen mixed signals lately. One potential bright spot that caught my eye is highlighted in CNBC's article. JP Morgan upgrades Gap, sees retailer shares rising more than 20% from here. It seems like JP Morgan is surprisingly optimistic about Gap's turnaround prospects. Despite the retailer's struggles in recent years, what's driving their bullish outlook? And do they think Gap can actually pull this off?
JP Morgan's optimism stems from a few key factors. First, they're impressed with the new CEO's strategies, which focus on improving inventory management, boosting marketing efficiency, and streamlining operations to reduce costs. They believe these initiatives have the potential to significantly improve Gap's profitability.
So to bet on the new CEO's ability to execute their turnaround plan.
Precisely. And they're also encouraged by Gap's performance during the early holiday shopping season, which suggests that their efforts might be starting to pay off. They believe Gap could achieve low to mid-single-digit sales growth in the coming years, which would be a significant improvement over their recent performance.
That would be quite a turnaround. But the article does mention that Wall Street as a whole is still relatively neutral on the stock, so there's still some skepticism out there. It's not exactly a unanimous vote of confidence.
That's true. The retail industry is facing a lot of challenges, from the rise of e-commerce to evolving consumer preferences. It remains to be seen whether Gap can truly revitalize its brands and regain its former market share. JP Morgan is taking a calculated risk here, and it will be interesting to see if their gamble pays off.
Let's wrap up this first part of our deep dive with something completely different. The world of cryptocurrency, which is always a hot topic. The Wall Street Journal has an article, Trump's return heralds litigation piece for crypto. That's got everyone talking. It suggests a major shift in the regulatory landscape for the crypto industry. It sounds like we could be seeing a more hands-off approach from regulators under the Trump administration, which is a significant departure from the previous administration's stance.
It is indeed. The SEC, under Gary Gensler, has been aggressively pursuing legal action against major crypto exchanges, accusing them of violating investor protection laws and selling unregistered securities. But with Trump back in the White House, that aggressive stance is likely to soften. The article suggests that potential successors to SEC Chair Gary Gensler are expected to be more favorable to the crypto industry and might even dismiss or settle existing lawsuits.
So it sounds like a reprieve for crypto companies who have been battling the SEC in court. But is this a good thing for investors? And the overall stability of the crypto market? Less regulation could lead to more innovation, but it could also open the door to more scams and fraud.
That's the debate, isn't it? It's a classic case of weighing the potential benefits of less regulation against the potential risks. On the one hand, a more permissive regulatory environment could foster greater innovation and allow the crypto industry to flourish. On the other hand, it could also create a wild west environment ripe for abuse, potentially putting investors at risk.
A tough question. On the one hand, excessive regulation can stifle innovation. On the other hand, a complete lack of oversight can lead to chaos. Finding the right balance is crucial, and it'll be interesting to see how this plays out in the coming years. We'll continue this discussion in our next segment, where we'll delve deeper into the implications of these global trends for investors.
Welcome back, everyone. Let's dive into the investment implications of these global trends we've been discussing.
Yes, let's get practical. If we're looking at Asia and this value up trend, where should investors focus their attention? Are there specific sectors or countries that stand out as particularly promising?
That's a great question. It's still early days, but there are definitely pockets of opportunity emerging. As we discussed, Japan is often cited as the poster child for successful corporate governance reforms. Companies there are generally considered more shareholder-friendly now, and their valuations are starting to reflect that. So for investors who are comfortable with the Japanese market, there might be some compelling opportunities to consider.
What about India? The Bloomberg article mentioned Prime Minister Modi's efforts to reform state-owned enterprises. Is that creating investment opportunities as well? India's economic growth has been pretty impressive in recent years.
Absolutely. Modi's reforms have made those state-owned enterprises or SOEs more efficient and profitable, which is attracting both domestic and foreign investors. India's overall economic growth, as you mentioned, is another major draw, making it a potentially compelling market for long-term investors who have an appetite for some volatility.
So Japan and India are looking interesting. But what about China? Their economy seems to be rebounding, but their corporate governance practices haven't always been the most transparent, have they? How should investors approach that market?
That's a valid concern. Transparency and corporate governance are definitely areas where China has faced criticism in the past. Investors need to be aware of those risks. However, China's sheer size and growth potential are hard to ignore. And as they continue to implement their own version of value up, focusing on shareholder returns and market valuations, it's possible we'll see more opportunities emerge for investors who are willing to do their homework and carefully assess the risks.
So it sounds like a diversified approach to Asian markets is probably the best bet for now. But what about these broader global trends we touched on earlier, like rising interest rates in Japan and a strengthening U.S. dollar? How should investors be thinking about those factors?
Those trends have significant implications for currency markets and global investment flows. For example, a stronger dollar can create headwinds for emerging market currencies, making it more expensive for those countries to service their dollar-denominated debt.
So emerging markets might be facing some challenges in this environment. Does that mean investors should steer clear of them altogether, or are there ways to mitigate those risks?
It's not necessarily about avoiding emerging markets altogether. They still offer tremendous growth potential. But selectivity is key. Investors need to focus on countries with strong economic fundamentals, sound fiscal policies, and manageable levels of debt. And for those who are particularly concerned about currency risk, there are hedging strategies available to help mitigate potential losses.
Can you give us an example of what a hedging strategy might look like in this scenario?
Certainly. A simple example would be using currency futures or options to lock in an exchange rate. Let's say you're a U.S. investor who wants to invest in Indian stocks, but you're worried about the rupee weakening against the dollar. You could use a currency future to essentially pre-purchase rupees at a set exchange rate, protecting yourself from potential losses if the rupee depreciates.
That's helpful to understand.
Mm-hmm.
And what about the impact of rising interest rates in Japan? That's a pretty big shift for them after years of near zero rates.
It is a significant shift, and it has the potential to shake things up. For Japanese investors who have grown accustomed to rock-bottom rates, it means they may finally start seeing some returns on their savings. But it could also make Japanese assets such as government bonds more attractive to foreign investors seeking higher yields. This influx of foreign capital could impact the value of the yen and create ripple effects across various sectors of the Japanese economy. We need to watch this development closely.
So it's not just about the direct impact on Japanese savers and borrowers. There could be broader global implications as well.
Exactly. It's all interconnected in the global financial system.
Okay, we've talked about Asia and some broader global trends. Let's zero in on some specific situations now, starting with France. The political standoff there seems to be escalating, with Marine Le Pen continuing to threaten the stability of the government. We talk about the bond yields widening. How concerned should investors be about this situation, and what are the potential implications if this political crisis deepens?
It's definitely a situation that warrants attention. Political instability can create a lot of uncertainty for businesses and investors, and uncertainty often leads to volatility in financial markets. If Le Pen succeeds in toppling the government, it could lead to significant policy changes that impact the French economy and financial markets.
The Bloomberg article mentioned that French bond yields are already widening compared to Germany, which is usually seen as a safe haven in Europe.
Mm.
Is that a sign that investors are losing confidence in France?
It's a clear indication that investors are pricing in more risk. The wider the spread between French and German bond yields, the less faith investors have in the stability of the French economy and the government's ability to manage its finances. They're essentially demanding a higher return to compensate for that perceived risk.
So for investors who currently hold French assets, it might be a good time to reassess their positions and consider reducing their exposure if they're worried about the political situation.
That's a prudent approach. It's always better to err on the side of caution when political risks are elevated.
Let's move on to Argentina now. They're offering those long-term incentives to attract investment through the REACH-I program, but as we discussed earlier, their track record isn't exactly confidence-inspiring. What are your thoughts on their strategy? Do you think it has a realistic chance of success?
It's a bold gamble, that's for sure. Argentina has a lot of potential, vast natural resources, a talented workforce, but it's been plagued by economic mismanagement and political instability for decades. That's a tough reputation to shake.
The Bloomberg article pointed out that many investors are hesitant to invest in Argentina because of its history of sudden policy changes and currency controls.
Yeah.
That's understandable given their past experiences.
Absolutely. Those are valid concerns. And until Argentina addresses those fundamental issues and builds a track record of stability and predictability, it will struggle to attract the level of foreign investment it needs to truly thrive. Investors need to see concrete actions, not just promises, before they're willing to commit significant capital.
So for now, it's probably best for most investors to watch from the sidelines and see how things play out in Argentina.
That's my recommendation as well. High risk can sometimes lead to high rewards, but in Argentina's case, the potential downsides are substantial, and investors need to be very discerning.
Let's turn our attention back to the U.S. and revisit a couple of stories we touched on earlier, starting with Gap. J.P. Morgan seems optimistic about their turnaround prospects, but Wall Street as a whole seems less convinced. What are the key factors that will determine whether Gap can actually pull this off?
I think it boils down to execution. Gap has some strong assets, iconic brands, a large retail footprint, a loyal customer base, but they've struggled to adapt to the changing retail landscape in recent years. The new CEO strategies sound promising, a focus on inventory management, marketing efficiency, operational savings, but it's all about execution. Can they deliver on their plans and revitalize those brands in a way that resonates with consumers?
So to bet on the new CEO's ability to turn the ship around and make Gap relevant again, what are the biggest challenges they're facing?
Well, competition is fierce in the retail industry, both from fast fashion retailers who are constantly churning out new trends and from online giants like Amazon who are capturing an increasing share of consumer spending. Gap needs to find a way to differentiate itself and offer something unique that compels shoppers to choose them over the competition. It's not going to be easy.
It sounds like they've got their work cut out for them. Now let's revisit the world of cryptocurrency. We discussed how the regulatory landscape seems to be shifting in a more favorable direction for the industry under the Trump administration, which could lead to less aggressive enforcement from the SEC. But some experts are raising concerns about the potential for increased risk and instability if regulations are loosened too much. How should investors approach this evolving situation? Is it a sign to jump into crypto, or should they proceed with caution?
I think caution is always the best approach when it comes to investing, especially in a market as volatile and unpredictable as cryptocurrency. While less regulation could potentially lead to more innovation and growth in the crypto space, it could also create opportunities for bad actors and increase the likelihood of scams and fraud, which could harm investors.
So it's a bit of a trade-off, isn't it? More freedom, but potentially more risk as well.
Exactly. Investors need to do their due diligence, understand the risks, and be prepared for volatility. They also need to be aware that the value of cryptocurrencies can fluctuate wildly, and there's no guarantee that past performance will be repeated in the future. It's not an investment for the faint of heart.
It sounds like a classic case of buyer beware. What are some key things investors should consider if they're thinking about dipping their toes into the crypto market?
First and foremost, they need to do their research and understand the underlying technology and the specific cryptocurrencies they're considering investing in. It's not enough to just jump on the bandwagon because everyone else is doing it. They also need to be aware of the regulatory landscape, which is constantly evolving, and choose reputable exchanges and platforms to trade on. Security is paramount in the crypto world, so protecting their digital assets from theft and hacking should be a top priority. and they need to be prepared for volatility and the possibility of significant losses. This is not a get-rich-quick scheme. It's a high-risk, high-reward investment that requires careful consideration.
Those are all excellent points. It's crucial to approach crypto with a clear head and a healthy dose of skepticism. We'll be back after a short break to wrap up our deep dive with some final thoughts and key takeaways for navigating these global market trends.
Welcome back to the Pro Ticker podcast. It's been a whirlwind tour of the global markets this morning, hasn't it?
It really has. We've covered a lot of ground. From Asia's value-up trend to political turmoil in Europe, a gamble on growth in Argentina, and even the shifting sands of crypto regulation. It's enough to make your head spin.
Definitely a lot to digest. But that's the nature of the global markets these days, isn't it? Constant change and interconnected risks and opportunities.
Exactly. So what does this all mean for our listeners? What are the key takeaways they should be considering as they navigate these complex and often unpredictable markets?
I think the most important takeaway, as we've touched upon throughout our discussion, is that diversification is more crucial than ever. We're seeing a lot of divergence in economic performance around the world. Some regions are rebounding strongly, while others are facing significant headwinds. Spreading your investments across different asset classes, geographies, and sectors can help mitigate risk and capture opportunities wherever they arise. It's the age-old wisdom of not putting all your eggs in one basket. But it's particularly relevant in today's globalized and interconnected world.
Makes sense. Don't bet on just one horse, so to speak. Spread your bets and increase your chances of coming out ahead.
Precisely. Another key takeaway, and this might seem obvious, but it's easy to overlook in the daily hustle, is that staying informed is absolutely paramount. Global markets are constantly evolving, and new trends and risks are emerging all the time. It's important to keep your finger on the pulse and be prepared to adapt your investment strategies as needed. Don't just set it and forget it. Be an active participant in your financial journey.
Our listeners tune into this show for a reason. They're engaged and want to stay ahead of the curve. But with so much information out there, from financial news websites to social media, it can be overwhelming. Any tips for staying informed without getting bogged down or feeling like you're constantly drinking from a fire hose?
That's a great question. It's easy to get lost in the information overload. I'd say focus on reputable sources of information, like the financial publications we've discussed today, Bloomberg, CNBC, the Wall Street Journal. Look for analysis that goes beyond the headlines and provides context and insights. Don't just read the what. Try to understand the why and the how. And equally important, don't be afraid to challenge your own assumptions and seek out diverse perspectives. Get out of your echo chamber and consider different viewpoints. It will make you a more informed and thoughtful investor.
That's great advice, thinking for yourself. And not just following the herd is so important. Now, any parting thoughts for our listeners? As we wrap up this deep dive and head into the final month of trading this year, what should they be watching for as we head into 2025?
I think the biggest wild card remains the level of uncertainty we're seeing in the global economy. Will inflation continue to rise, forcing central banks to raise interest rates more aggressively? Will political instability in Europe and other regions escalate, further rattling markets? Will the value-up trend in Asia prove sustainable, or will it fizzle out? These are all questions that investors will need to grapple with in the coming months.
It sounds like 2025 is shaping up to be another year of potential volatility and unexpected twists and turns. Buckle up, everyone.
Indeed. Stay informed, stay nimble, and don't be afraid to adjust your course as needed.
That's a great note to end on. Thanks for joining us on this deep dive into the global markets. We'll see you all tomorrow morning with new headlines from major financial magazines. Until then, happy investing.